Global share markets ended last week higher, with both US and European markets in positive territory. The introduction of further quantitative easing measures by the US Fed has been seen as being positive for global share markets. Some more positive labour indicators coming out of the US has also been positive for global shares. 150,000 jobs were created in the US over the past month, and this is about twice as many as most people were expecting. The unemployment rate does hold steady at 9.6%. Currency markets have also been pretty choppy, with the Australian dollar strengthening against the US. At one point it was trading at 1.02 against the US dollar. The Kiwi is also very strong against most currencies and starts this week trading at 79.6 against the US and well over 49 against the Great British Pound. There has been plenty of talk in global markets over the past week or two about the further measures from the US Fed in terms of quantitative easing. Many people expect that this is just printing more money. However, the issue is far more complex than this, and in essence, it is when the US Fed will buy longer-term corporate and bank bonds. The effect of this is twofold. First off, it does allow more money into the financial system. Therefore, banks should be able to lend more out to businesses and consumers. The second is that it lowers the yield on longer-term bonds, which in turn should lower the interest rate for the similar measures. The effects of this is that there should be more money in the system and the cost of borrowing should be lower. Therefore, this should be stimulatory as more businesses and consumers will be out there spending. The effect on us here in New Zealand is that it could potentially push down interest rates. However, we aren't expecting this to happen, as there have been some positive economic measures come out over the past few weeks. The other effect it could be on the currency, and we have already seen our New Zealand dollar strengthen, and it is likely to stay stronger with these measures in mind. It's not surprising to see the New Zealand beef schedule price fall over the past week with the strengthening of the New Zealand dollar against the US. This comes despite international prices remaining very strong and looking good for the current year. The latest export data indicates that Australian exports into the US market have fallen dramatically and are now down to the lowest level over the past 10 years. International markets are still looking pretty good, and we are expecting to see prices stay strong right through this season in our major markets, particularly in the US. However, with the New Zealand dollar remaining very strong and strengthening up to just under 80 cents against the US, this will put some pressure on beef schedules. If it remains at these levels, I wouldn't be surprised to see further drops in the schedule price. We have been expecting to see New Zealand beef schedules average higher than they were through 2009. However, if the currency remains strong, we may see some weakening from these levels.